Welcome to the Decision Makers. Hi, I'm Jerry Sont. Today we look at cash as an investment choice and the considerations it raises for banks and advisors and other people working in the wealth management industry. We'll tackle some of the common issues and concerns surrounding cash and provide some in-depth insights into client requirements and some solutions to meet those needs. In this program, Decision Makers will share their thoughts with you. I'm speaking now with Simon Teong, Head of Corporate Investments, New South Wales, St George Bank. Simon, welcome to the Decision Makers.
Jerry, thanks for having me.
Simon, has there been a noticeable shift away from cash as an asset class?
Jerry, I think it'd be fair to say that we haven't really seen a noticeable shift away from cash. And I think some evidence to support that would be looking at last year's figures that APRA released. There was an 8% increase in national deposits. And if we sort of compare that to the GFC period, that figure was around 20%. So it has come off a little bit, but there is still growth there.
What is driving this continued investment in cash?
Well, Jerry, I think there's probably two key areas to look at in that perspective. The first one is the uncertainty around global markets at the moment. And I think in particular, Ireland was a good example last year. So issues around sovereign debt, uncertainty in Europe, things like that often drive investors back to what they know and what they're looking for. And two key things there is really liquidity and capital security. So that's definitely a focus for investors. Secondly, I think what's been driving that push is around this premium that the banks are actually offering on their deposit products. So at the moment, we could see that the competitiveness of deposits in the banking sector is leading banks to offer quite substantial returns on cash style products. And so some research that the RBA has done recently actually shows that the actual margin for deposits that they're offering is around 125 basis points above cash. So as a historical level, that's quite large compared to pre-GFC. So from that perspective, the banks are obviously offering these greater deposit levels. And a lot of that has come on the back of higher costs of funding. And that's something that the market and the press has mentioned quite a bit. So it's an area that the banks are focused on. So because of these premiums, investors are quite happy to actually invest in these higher returns.
What will be the catalyst for this cash to return to equities or other investment classes?
I think there's probably going to be another key couple of things that need to happen first for any change. And the obvious one will be some stability around the global markets. So again, we're going to need to see some history of probably positive performance from areas like equities. So people have to be comfortable again to know that now's the right time to move back into those products. So if the cash products are still offering that premium and people are comfortable to keep liquidity and capital security, then that's definitely a focus for them.
Any other factors?
Yeah, look, I think the other key factor, and one we've already talked about, is around that premium on pricing. So at some stage, I do believe that wholesale funding might actually reduce in its cost, so therefore banks might actually be able to access that market again. And if we see that, that premium on the deposits is actually going to come off a little bit. So investors at that point might then start to look for other opportunities in the market. So what does that sort of mean? Well, things like the debt market might actually start to improve a bit. And by that, I mean retail bonds. So we might actually start to see more in the form of banks and corporates looking to raise money through the issuance of retail bonds in the market.
Given the experience of the GFC, do you think there's a permanent shift in asset allocation towards cash?
Look, I think the consensus would be that that's definitely the case. I think investors and advisors alike are now actually taking a focus on what their cash allocation should be. So the two sort of questions that they're really asking themselves is, do we have the right weighting in our portfolio? And do we have the right cash products in our portfolio? So quite an important area for people to consider. Also, given the premiums on the deposits that are currently offered in the market and the fact that we do have an ageing population, I think there is going to be greater demand for cash products within the market. And I think this has actually been supported by product development within the wealth management arena. So as an example, we've seen platforms now offering term deposits. Also, we're seeing banks develop different products that look to match that particular section of the market. So one would be a term deposit that might be linked to the performance of inflation, as an example. So definitely there's been a shift, and I think it's going to be quite an area of focus going forward.
Given we're talking about cash, what is the St George outlook for the RBA cash rate in 2011?
So over 2010, we've seen 4 increases of about 25 basis points each time. I think November probably took us a little bit by surprise. Things that we're seeing happen from that last rate rise is around retail sales, obviously being off, and also I think the RBA's have to have a real focus on the level of household debt. Okay, so given these 2 areas as an example, it's definitely going to be probably a rate rise, we're thinking June 2011. So probably likely for a couple of months now, no rate rise, and then as we head into the end of 2011, possibly 1 to 2 25 basis point increases through that period as well.
Simon, as a decision maker, thank you for your time today.
Thank you, Jerry.